So the company I'm going to look at as our star of the week is Argan Inc., symbol AGX on the New York Stock Exchange, trades around 94.65, $1.27 billion market cap, does pay a dividend and has been growing that dividend. What does Argan do? They're primarily a construction firm involved in power industry services. 75% of the business is there. About 24% of the business is industrial construction. There's a small percentage, 2.5% in telecommunications. The company provides a full range of engineering, procurement, construction, commissioning, maintenance, project development, and technical consulting services to the power generation market. Their offerings focus on engineering, procurement, and construction of natural gas-fired power plants and renewable energy facilities. So why has the stock surged 34% in the past couple of days, and why has it doubled in 2024? The jump in the past couple of days was produced by what we call a blowout quarter in terms of earnings. You can see the headlines here. Argan's EPS of 131 beat by 34 cents, and revenue of 227 beat by 35.95 million. So the company smashed analyst consensus earnings estimates and easily beat the most optimistic street estimates on revenues. This drove the stock up over the last couple of days. The year-to-date gains are really just a continuation of this trend. It's just been going on throughout the course of this year. Positive outlook in the quarterly conference calls from management, and a backlog, which we'll touch on in a second, that is moving to record levels from significant contract wins. So let's take a closer look at those numbers that led to the jump this past week. These are the Q2 earnings snapshot here. Revenues growth was up 61%, earnings up 39%. Gross margins were lower, which is something we are monitoring, but this is largely due to a changing project mix in the quarter and will fluctuate with differing projects over time. And it's, again, something we monitor. Let's look at the 6-month snapshot here. Again, shows you a continuation of the growth that from Q1, and it even accelerated into Q2 in terms of the top line. So let's take a look at the key. Well, first we're going to look at the balance sheet here quickly. Sorry. Strong balance sheet, which is what we like to see. One of the elements that really has attracted us to this business is, this is a more volatile business than we traditionally recommend, given its contract-driven nature of its work. So that strong balance sheet that continues to strengthen kind of gives you a little bit of a cushion here. Huge cash balance relative to the market cap. Even with the surge in the market value of the company over the course of this year, it's still 38% of the market cap is in cash with limited debt. We like to use net liquidity as a better view of the actual or excess cash for Argan, but this is still very strong at about just under 260 million. Okay, well, let's look at that backlog. Argan closed the second quarter with a backlog of roughly $1 billion, which reflects an increase from the last quarter of approximately 210 million. 570 million are in renewable projects. Now, commenting on the backlog and outlook, management stated that the addition of high energy demand data centers, the onshoring of manufacturing operations, and the expansion of electric vehicle use are primary drivers for increasing forecasts of future electrical power demands, and the robust pipeline of new opportunities that Argan sees. Argan's pipeline remains strong, and the company is confident that its energy agnostic capabilities and proven success leave the business well positioned to compete effectively for a growing number of projects coming to market. Now, we're going to look at the valuations quickly on the business here. I highlighted the 2024 forward P or 2025, forward PE. It may come down given the increase in the backlog, and that's probably on an earnings estimates that go higher in the near term and even into next year based on that earnings beat, like I said, and on the increase in backlog, which should increase earnings in future periods. So quickly, our conclusion here. Clients will be updated on this stock over the next week. But the 33% gain in the last 2 days, the 100% gain year to date, make Argan our star of the week.
And it's an interesting company. I mean, one of the things that we noted when we were doing our research on it is that it is a very contract based company, right,
Yes.
Ryan? So,
Yeah.
there can be fluctuation historically in the financial performance, but it also had a huge net cash balance
Yeah.
when we recommended it. So, we knew that there was, opportunity to make more dividend payments, potentially invest in some other um, internal growth projects as well.
Yeah. It gives you, it limits. These businesses can be highly volatile. So, you can have a business collapse if they have a significant net debt position and they're servicing a ton of debt and the projects dry up in the near term. Like, these businesses can have ebbs and flows in business. So, if you're going to hold a stock like this that has higher than average degree of volatility, make sure the wind is at your back. And we saw those three things driving the business. You want that wind at your back in terms of business going forward, and then you want that solid balance sheet. And if they can be profitable, then you can have a significant jump. And Argan has worked out tremendously well in terms of what it's done over the course of this year. And with the growing backlog, that strengthens the opinion going forward into next year. And if they can continue to grow that backlog, it does say that, and management has stated this, and they stated this when we originally invested them or recommended them, that the business had a very strong pipeline, and they're delivering on that because you saw backlog increase significantly in the last quarter. They have these large projects they're bidding on right now, so we could see a continued backlog increase, which would be great to see in this business. That's going to lead to higher profitability over the long term, as long as they can execute on those contracts. They have in the past had a few contracts where the execution was sometimes not all their fault, but if it's poor, then your margins are down. So you have to watch. It's not good enough just to have the backlog. Got to execute on it profitably. Costs have to be kept in control. We're seeing them do that, and that's why you see a jump in the share price over the course of this year. And the valuations right now still aren't terribly unreasonable, particularly when you factor in that very, very strong balance sheet.
Yeah, just on backlogs, the reason why it's so important to see conversions is in many management, they like to inflate it, and it's questionable always at first until you have that track record. So even if they say they have, let's say, 100 million backlog or something like that, if they're only getting really 10, 20 million of that, it's not a useful backlog in that sense. And you will see that occasionally, maybe not to that degree, but it is something which you need to be cautious of, and you need to see that track record, especially when it comes to backlog, because you need to see conversions, whether how much, because it really depends on the contract nature of the business too. Are these actually just customers saying, "Hey, we want this 5 years from now," and there's no contract, or is it they've already signed it? And there's very big differences in backlog, so you can never really compare one companies, even in the same industry, backlog to another. That's why you like to see that
Yeah, you
conversion.
need to see management deliver on that backlog,
Mhm.
and then there's teams that talk about pipeline and are the size of the market, and investors sometimes conflate those two things. And if it is a signed contract backlog, you still have risk in that, but it's certainly better than a pipeline or what we're bidding on or the market size that we're looking at. And then, like Brett says, they have to execute on that over time and actually produce out of their backlog. And if they're losing 40% of their backlog every year that they've quoted, you can't take that backlog to be a good solid number that you can do any modeling off and forecasting going forward.